Hi, and welcome back to another episode of the Mortgage Musketeer, where today we're going to continue the series of the first-time homebuyer class, and we're going to focus on your cash to close. All right, so a lot of people don't understand what cash to close means, so we're going to break that down to figure out what do you really need to bring to the closing table. Okay, so let's go ahead and jump right in. So cash to close is a misnomer from the very beginning, because if you watch any of my videos, you know the very first one I ever did was cash is the devil. All right, so you cannot bring, or you cannot use cash for closing. Okay, now what the cash to close really consists of is three things. It consists of your down payment, your closing costs, and your prepaids. All right, so let's focus on the down payment portion. Your down payment is what percentage of the sales price are you going to bring to the closing table? And everybody wonders, well, how much do I have to put down? So it's a difference between how much do you want to put down versus how much you have to put down. And we've talked a little bit about this in the last video about minimum down payments. So if you're not putting 20% down or more, then if it's an FHA loan, you know it's 3.5%. If you're doing a VA or a USDA loan, then it could be 0%. And then if you're doing a conventional loan, it's anywhere between the 3 and 5% minimum. Okay, so 3 to 5% or as much as you want. And that goes with any of the loans. So the bottom line is your down payment is a very specific amount, and you set that aside. That's part of the cash to close that you're bringing. Okay, and then you have your closing costs and prepaids. So most of the time people put all three of those together and call it your cash to close. So just understanding that they're three separate entities is really important. Now, your prepaids are items that you're going to prepay. Okay, hence the name. It's not just a clever term. Prepaids tend to be your homeowner's insurance, also called your hazard insurance, and establishing your escrows for your property taxes and your homeowner's insurance. And the reason for that is because when you close your home, whatever month you close in, you're paying 12 months of homeowner's insurance or hazard insurance up front. So next year on that same day, your homeowner's insurance is due again. But when you close, whatever month you close, typically you don't have a payment for another 2 months. So for instance, if you close in the month of March, your first payment wouldn't be until May. So what that means is that next March, you've only made 10 payments. So there's not enough in your escrow account to pay next year's homeowner's insurance. So they're going to establish your escrow account. And on average, it's typically 2 months plus a 1 month buffer to make up for that time. Okay, so that's prepaid. You're going to prepay your escrows into, putting that money into an escrow account so that next year you're going to have enough. It's the same concept with your property taxes. They're going to figure out how much you need in your escrow account for your property taxes so that at the end of the year, your loan servicer is going to pay your property taxes for you. You don't have to worry about it. So those are your prepaids. Now your closing costs consists of all the title fees and maybe your anything that goes into maybe underwriting fees. A lot of it has to do with title work. It has to do with actual your owner's title insurance goes in there as well. Deed prep, any taxes, depending on what state you are, taxes are a big deal because when you're dealing with Maryland and Virginia, they have deed taxes and all kinds of stuff. So there's a lot of stuff that goes into these items that you need to get with your loan officer and find out, hey, what are my closing costs and prepaids going to be? Now, oftentimes we talk about closing costs and we kind of roll them into one. So don't be thrown off by that. All right. Now, your closing costs and prepaids can be paid by the seller if you negotiate that up front. So when you get pre-qualified or pre-approved, your loan officer should be telling you how much your closing costs and prepaids are estimated to be. That is a key and critical component because you need to know how much money do you need to bring to the closing table. Also, they should be doing it because if they don't, then they're not verifying that you have enough assets, enough money, either in the bank or in a 401k or wherever it's coming from. They need to make sure you have enough money to actually close the home. And I've seen so many loan officers that don't do that. They're afraid to ask how much money that you have. and they don't do the calculation to figure out how money do you need, which blows my mind, but it happens all the time. So just know this up front. If they're not telling you how much it is, it's important. Now, oftentimes that can be a much larger number than you anticipated. All right, so this is very important that you understand that closing costs and prepaids are an additional expense to closing on your home. And that's why you need to know how much money do you have for a down payment and how much is it going to cost you in closing costs and prepaids. Because if it's more than what you have, then you have to negotiate that into the contract. The sellers are going to have to pay for it. Now, how does that work? I have a whole video on it. I'll link it up here so that you can understand how that goes. Same thing, I'll also link another video that references what are escrows and how are they built right here. Okay? So those are really important to know as you're preparing to buy. How much are you actually going to need for a down payment and closing costs? All right, hope this helped. This is a quick one today. If you have any questions, leave the comments below. I'll make sure that you get squared away. But until next time, it's all for one and one for all.